All right, everybody. We are going to get started here in just a second as we kind of see all the participants starting to jump in. I can see the numbers starting to pop up. I'll give it just a minute for everybody to kind of file in, and then I'm going to jump in and just give us a quick state of the market. Our panelists tonight, as we're getting started, is Glenn Stromberg, which is my partner in a fund that we'll talk about in a little bit here, as well as Justin, who is doing a lot of the asset management in that project. I'll kind of give you a quick overview here in just a second, and then I'll have Glenn also give an overview of just his background, and then we will jump in. So I'll just give it one more minute and we'll get started. If you are, just as you're kind of jumping in, feel free to use the chat for any questions you have. As well, you can use the Q&A button, but chat's probably easiest, and just address any of the questions to us all together. Well, let me just go ahead and jump in. I'm Eddie Wilson. Thank you so much for joining us tonight. It is our pleasure to host this. I know that there's a lot of speculation and to some degree fear over what's going on in the market with the Fed raising interest rates again just a day or so ago, 0.75%, and raising for the third time is kind of an unprecedented thing going on. And I know that really what prompted this webinar was the calls and text messages and all that I had, all the responses I had from all the different changes in the market on how should I think about this? What should I be doing? And where's the opportunity at? And so that really prompted a lot of this. And so I wanted to speak to that and hop on tonight. And if you're watching it by way of recorded version, feel free to send us an email or contribute on social media, where we'll be happy to respond there after the fact. But again, if you don't know me, I think most of the people that are on here probably do, but I'm the founder of Think Realty, Eddie Wilson. I'm an avid real estate investor, third generation. Grandfather's a real estate investor, dad's a real estate investor, and I am as well. So as much as I involve myself in private equity and buying businesses, I very much invest in real estate as a way to create wealth, as a way to keep wealth, and as a way to protect my wealth. So Glenn, if you don't mind, just give us a quick introduction as to who you are.
Yeah, my name is Glenn Stromberg. I have been in the real estate industry for 40 years now, which that blows me away to even say that, but actually been in the manufactured housing space. And so I've seen several different market cycles, and I'll have more to contribute there. But yeah, I'm the owner of Stromberg Investment Group, and we buy manufactured homes on land in 4 states: Texas, North Carolina, South Carolina, and Georgia. And we have well over 100, and I think it's over 125 investors now, and I think we have like 500 something doors under management. So that's an overview of what we do.
It's great. Justin
Hammaker, work for Stromberg Investment Group. I've been kind of spearheading the acquisitions and process procedures, but I'll go over a little bit more in depth. We can talk about the fund, our assets and stuff. But kind of like Glenn said, our business is mobile home on acreage, and like I said, a lot of people never think about that, the type of investment or that type of setup. But like I said, we'll go over in a little more depth later.
Thanks, May. May said that the chat is disabled. So if you want to ask questions, you'll put that in the Q&A just for future reference. So if you click the Q&A link at the bottom, that's where we'll put all the questions tonight. So let's go ahead and jump into the presentation. I'm going to share my screen here, and we'll jump in. So I've titled the presentation Thriving Through Hard Times, because that's what I think a lot of real estate investors are feeling like is going on right now, is that we're going through hard times, difficult times, times. If you're listening to mass media, you are thinking very differently, I guarantee, than the way I think, and probably the way Glenn thinks. This is my 3rd real estate cycle that I've been through. I started investing in the dot-com crash in the year 1999, 2000. I've invested through 2008 through 2010 and the Great Recession. And now they're calling this period of time the Great Inflation. And so I'm now investing through this period of time where we're just seeing unprecedented information and things coming out. And just knowing how to navigate that is really, really important. And so I just want to help you through some of this and really process a way to think about what's going on in our nation, in our economy, and everything that's surrounding us as real estate investors. And so by way of just kind of introduction, here are just some of the companies I own. I'm a private equity investor, own Think Realty and various other things, but invest heavy in real estate. But I want to point out that all of us today have one of two mindsets. I want you to think about the way you're processing the market, everything that's going on right now. You're either thinking about it like an investor or you're thinking about it like a consumer, an investor or a consumer. There really is no other way to think. And if I could be so bold as to say that if you're listening to CNN and CNBC and Fox News and Facebook and Instagram, you're most likely thinking like a consumer because we are programmed to think like consumers. When we are given data and information, we're told through mass media how to process it, but we're programmed to consume. And I'll explain that in just a second. However, we want to think very differently during these time periods. We want to think like an investor. And so let me just give you a quick test. Are you ready? When you are thinking about the market right now, are you thinking about it with all of its opportunity, or are you thinking about it with all of its liability? If you're an investor, you're thinking about all the opportunity. If you're a consumer, you're thinking about all the liability, okay? Are you thinking about it based on the return on investment, or are you thinking about it as cash or safety? Meaning, I'll give you a quick, for instance, when I'm still buying doors, still today buying doors, and still actively looking for investments. And my focus is on the return of those investments. I haven't totally shifted my focus to how much cash can I hoard, right? Which comes to the next point. Are you still accumulating assets or are you accumulating cash? It's not bad to be in a heavy cash position right now if your focus is to go get more good deals. However, if you're accumulating cash just for the purpose of safety right now, you're oftentimes missing the awesome assets that are just sitting there ready that many other people they're programmed to be consumers are missing out on. Are you thinking about cash for acquisitions? Or are you thinking about cash for savings, right? Which is just, I just talked about. And as I walk through this, I want to talk to you just for a second about, this is the Oracle, right? Warren Buffett. Warren Buffett is not a real estate investor. Warren Buffett is a private equity investor who does have a lot of real estate holdings, by the way. And he is sitting on $180 billion in cash. This is the largest cash position Warren Buffett has ever been in. The New York Times said that he is scared of the economy and what's going to happen in this economic marketplace. And to that I say, and you can actually go to the Twitter war I had on Twitter with this New York Times person, where I said, you obviously have not been watching Warren Buffett for the past 50 years. If there's any reason that Warren Buffett has $180 billion in cash sitting on the sideline, it's because he thinks there's greater opportunity that's about to come into the market, and he's about to feed, in the end, he's a shark. Like he is a real estate, or he is an investor. He's a private equity investor. And to this point in 2008, Warren Buffett went into a very heavy cash position and he was worth right around $40 billion. In 2010, he came out of that same time period, which the whole nation looked at as this economic disaster. And guess what he was worth? He was worth $82 billion. Warren Buffett doubled his net worth because he knew when it was time to hold cash and when it was time to invest the cash. Now, we are a small microcosm of Warren Buffett. None of us even would make the richest among us would never make the radar of Warren Buffett, right? $180 billion in cash, we can't even fathom that. As a matter of fact, I read a short survey recently that said, if you have $1 billion today, billion cash, it's statistically impossible to turn it into 2 billion cash, and that there's such a small amount of people that possess the ability to do that. You say, well, why? I've heard that it takes money to make money. Well, there's actually a law of diminishing returns. The highest level of taxation goes to the wealthiest in our circles, right? So if you have $1 billion, taxes are against you. If you have $1 billion, the government's against you. If you have $1 billion, do you know how many deals and assets you have to underwrite in order to turn that into 2 billion? If you have $1 million, I can successfully show you how to get to 2 million, and it's actually fairly easy. If you have $1 billion, I've read that it's statistically impossible to turn into 2 billion. You're actually going against stats, right? To actually turn that into 2. Well, he's sitting on 180 billion. That's a lot of money. But the point that I'm making is that even the New York Times, when they look at Warren Buffett, they go, oh, he's terrified of the market. And I say, he is not terrified. He believes that he's going to take that 180 billion and he's going to pass Tesla, or he's going to pass Elon Musk for world's richest man, because he knows exactly what he's doing, and he's going to buy a ton of assets in the next 6 months to a year as they come available. So what's he waiting on? He's waiting on assets that he believes can perform at the highest level. And he believes that these assets will perform at the highest level during this short period of time that's coming up in front of us. So let me just give you some stats, because if you're listening to CNBC, you're listening to, the pundits that are out there, you're getting misinformation. And if you think that the mass media, and this is not a political statement by any means, but if you believe that the mass media is feeding you data that is beneficial as an investor, I can say that you're misinformed, because you're not hearing the stats I'm about to give you on mass media today. Number one, we are still 6.5 million homes underbuilt in the United States. That's how much demand is out there. Now, I sat on a panel just recently where a big, very well-known realtor talked about how even the websites, NAR and others, are seeing 4 million less views than they were 2 or 3 months ago. And all of that is, in my estimation, fodder, because that does not necessarily mean that we don't have the same demand, right? There may not be the same interest, but there's still the same demand. Interest slows down the process of purchasing. Demand says that the purchasing will always happen, if that makes sense. We may not see the same purchasing acquisition of, activity. We may see it slow down or elongate, but we're still going to see these assets purchased, or we're going to see people move into what we're going to talk about here in just a minute, which is rentals. Because no matter how much we build right now, no matter how hard we try, we cannot overcome the deficit of the housing demand that we're in. Now, if you're a real estate investor, that should be perking up your ears, because when there is a supply or a demand issue, we always have a clear path to make money as a real estate investor. The demand is still there. And the ability to create supply is now being choked off by the interest rates and the government structure that's being put around us. So if you're following me, what I'm saying is there's current demand of 6.5 million homes that we need in the marketplace that would be consumed in our marketplace if it existed today. However, with interest rates rising now, again, we're seeing builders starting to get a little bit nervous, slowing down their processes. Instead of building 10 or 15 or 20 at a time, they're building 5 at a time. I've talked to a lot of builders that have decided to slow down just a little bit. Why are they doing that? Because they don't know how fast these homes are going to be purchased. What does that mean? It's going to create an even bigger demand problem. Where are these people going to go? Well, I'll tell you in a minute, but as kind of a precursor to that, they're going to end up renting. But next, if you look at our interest rates, which this is what everybody is talking about right now, interest rates have gone up another 0.75%. Can you believe it? The thing that I want to point out is that if you go back 14 years ago, and again, this is not a political statement, but you go back under the Obama administration, the interest rates were still higher than they are right now with the last 0.75% interest increase. 2008, our interest rates were still higher than they are today. That's important to note because most of the people that are making larger purchases today, right? They've already experienced what it is to pay 6.5% or 7% in interest. The ones that are starting to slow down a little bit are those that have never paid it. What group is that? Well, that's the millennials who already were struggling to make purchases. They have just begun over the last year or two to start buying in the marketplace. We're starting to see increased activity. The thing is can I tell you a secret about that generation and even my generation, which is Gen X, which is we are entitled. And we don't really care what the asset costs. What we really care about is how much does it cost per month, and can I get it? I don't care. And that's what's happening right now, is that if in the end they can buy it, they still will buy it. They don't care what it costs. They care what it costs per month. They're the Netflix generation. My generation is included in that. I'm in my 40s and I'm the Gen X, and then, beneath me, the millennials. And we're an entitled two generations of people that we really don't care. We struggle, my generation and beneath, the next generation struggles with delayed gratification. And so in the end, do you think that it's going to stop them from buying? It may slow them down. It's not going to stop them. Next, I want to point out this stat, and you're not hearing this, but we're hearing this first part, that the average family has a expenditure of additional $450 per month because of inflation. This is a stat that came out of the White House. But the point that I want to make is that if you go back to 14 years ago till today, the same family is making $1,200 more per family. And so while, we say, well, man, I can't believe you got $450 more that we're putting out. Well, guess what? If you just look at stats, right? Just stats, 14 years ago, during the Obama administration, which is 2008, from then till now, the average family is making more than $1,200 more across the nation per family. And then lastly, FHA affordability. This is a big deal, because FHA affordability is what really allows the person that's buying to be able to buy more, right? It allows them to extend their monthly payment. It has increased on average $52,000 per asset, meaning that if they qualified for a $200,000 FHA loan in 2008, they now qualify for an FHA loan for $252,000 in this marketplace. And by the way, they're at the best interest rates with the lowest down payment. And again, it goes back to these entitled generations that we live in today that really don't care what the actual total cost is. What they care is you tell them, do you know that the truck you just bought cost $80,000? They don't really care. What they care about is that their payment is under X amount per month, right? And that's how this generation thinks. They're financing their futures for today. Now, with all that being said, that's what's going on. So I want to draw it to a couple pieces of conclusion, but I want to give you a quick case study. And I just did this recently because I want to get into your mindset just for a second. This is a house I just built in Cape Coral. Built by Whitestone, financed by Yieldy, managed by Cohen Rental Management. This is a simple little house, right? I want to show you these are all the pictures, and we kind of jump through there. It's beautiful. You got it on a canal. But let me go over the build stats, because this is where people are like, I don't know what I should be investing in, right? Right now, 2021 build stats, this house, $50,000 saltwater lot. That's what I bought it for. $15,000 for lot improvements. Cost me $225,000 to build this house. It cost me about $320,000 all in for this house. I got a $680,000 appraisal in 2022, which said that after I was done with this house, when I went to finance it, I had $360,000 in equity. And I'm currently getting $6,000 a month in average rents. Okay. They're digging the backyard out for the pool right now. And so the rents will actually go up when the pool comes in. The thing is, at this conference I just spoke at, I said, how many of you would do that deal? You'd put, $320,000 in to get a $680,000 appraisal, and every single hand went up in the room. I said, well, let me show you the exact same house about 6 to 8 months later. That same lot that I bought for $50,000 is now $250,000. Okay. Then what cost me $15,000 cost me $25,000 for lot improvements. The build cost used to cost me $225 to build this house. Now it cost me just a little over $300,000. It's right around $305,000. My all-in cost for this house now is $575,000. Now the appraisal, and I just got one recently, is $700,000. So now I'm putting $575,000 into this house, and I'm only getting $125,000 in equity. And I said, how many of you'd like to do that deal now? And, you know, maybe an eighth of the room raised their hand. And the reason is because what you're seeing here is a very clear where, you know, I may be interested in doing some of these. A lot of you may not, because in the end, it's diminishing return on the same type of activity that we were doing a year or two ago, right? And so the point I make on this is that if you're still trying to do the exact same thing that you did a year or 2 or 3 years ago, you may get slaughtered, and you better be very careful, because if you are doing the same thing that you used to do and the market has changed, you look like this is a stark reminder of what has and how the market has changed. It went from $320,000 all in to $575,000 all in. And now I've got a very small piece of equity in this house, right? If I'm only getting financed at 75, 80%, and I can't get good underwriting terms, I might struggle to get this house financed long-term, right? And you might as well. And so I just want to, the reason I give this to you is because I want you to just consider, if you don't know the numbers of how you're investing today are impacted by everything that's going on, you might want to dive in deep to that. So my latest venture is based on lowest supply and unprecedented demand. We are going to talk to you about an opportunity tonight, and we're going to share an opportunity with you. And for those of you that kind of stuck through the presentation, I'm going to let Glenn just give any, you know, obviously I was doing the bulk of the talking there, but Glenn has also gone through multiple real estate cycles. He's been investing for 40 years. I want to hear his thoughts on it. But let me tell you just kind of my kind of conclusion of what I just said to you, and then I'll turn it over to him to get any comments there. Is that right now what I believe you need more than anything is I believe that you need assets that are in the affordable housing sector, because that's where the greatest level of demand is. And my dad always said this to me. He said, Eddie, he said, if you solve somebody's problem, you'll never lack for a client and you'll never lack for profit. Solve their problems. Everything you do, solve a problem. If you solve a problem, you'll never lack for a client. You'll never lack for profit. And what I believe right now, the problem we should be focused on solving as real estate investors is affordable housing and providing more rental stock to those that are not going to be able to buy the house that they wanted to buy in the last 6 months. Yes, some of them are still going to buy, but the problem is the ones that we're going to buy are not going to even be able to find something to buy, right? They're still getting priced out. In my neighborhood in North Georgia, north of Atlanta, our houses are still going off the market. I was talking to a realtor this morning, and he said, Eddie, he said, it's the craziest thing. He said, with a 0.75% interest rate rise, he said, I still had a house that was set on the market for 1 day this weekend. He said, it's the craziest thing. And so I believe the problem we should be solving is that. And the second problem I think we should be solving is making sure that we have access to our cash in short periods of time. Meaning, I don't want a bunch of cash because of inflation. I don't want to be Warren Buffett and have $180 billion sitting in the bank, because inflation is eroding at it every single day. And so because it's eroding at it every single day, I want to be able to find short-term investments that if I want access back to my cash, that I can naturally go get it and then double down on something even bigger. And so I believe that we've got a way to solve that, but I'm going to open it up to Glenn. I want to hear your thoughts on the market, the 0.75% interest rate rise, you know, and then any comments on what I just shared.
Yeah, no, everything you shared, I agree with wholeheartedly. I always tell people this. I think we're in uncharted territory, to be honest. I don't know what's going to happen. I'm not sure, but I do know one thing. I do know one thing. You know, you put the deal about Warren Buffett. I used to have a Clayton Homes franchise that Warren Buffett bought that company. And he bought Clayton Homes, the biggest manufactured home, manufacturer dealer in America. And he put out a quote one time, he'd buy 25,000 single family homes if he can manage them, right? So he understands the value of affordable housing. I'm gonna liken this time to 2008. The opportunity, I believe, a lot of times real estate investors got it backwards. The opportunity is ahead of us, right? In 2008, we were buying properties at 50 cents on the dollar. In our asset class right now, and I'll give you this is a kind of a good tell. 6 months ago, if you didn't put in a full price offer, nothing, you got nothing, right? Justin can talk more about this, but right now, we're getting people calling us back, dropping it significantly, right? There's certain pockets of the country to where stuff is still selling fast, but even here in Texas, where Texas is next to Florida, is the fastest growing state in America. Days on the market are growing in a lot of areas right now, right? And really, 2-3 years ago, we couldn't even buy houses in Texas. They were going too high. It's heading our direction right now. So we're seeing the cracks in the market. I believe it is starting to happen. Is it going to be another 2008? I don't know, but I do believe that what you said is absolutely spot on. It's been this way since I've been in the real estate business. All people care about is down payment, monthly payment. Can I afford the home, right? I believe that over time, less people, I think the Fed's in a box. They've got to keep raising interest rates to have inflation under control. But if they go too high, it could be devastating for the economy. So I don't think there's a good solution, a good long-term solution. And I think there will be. In 2008, what happened, I think it's going to happen again. There's going to be less people buying, more people renting, right? To where, and I always say this, and I believe this with my whole heart, right? No matter how bad things get, people are going to eat first, have a roof over their head second, right? And when you've got the most affordable roof, you're in a good place. My attorney says never say recession proof, so I don't, but recession resistant is what, like our asset class is. So, that's where I feel good about that. I do feel, part of like what you said about the short term, I'm noticing all our investors, people I talk to, they don't want to tie up their most funds and syndications are for 3, 5, 7 years. And that's why we structured it the way we did with a 1 year hold, right? Because it's a short period of time, like you said, you get your capital back. So I think it's a very good, safe place to be. Backed by affordable housing is a great place to be right now.
It's great. And so what I want to do is I want to show you an opportunity. If you're sitting there, I hope that you will take action. The 2 points I wanted you to take action on was, number one, you better know your numbers. If you're going to consistently do what you've been doing, right? If you're wholesaling, you better know how the current marketplace is affecting your wholesaling. How much longer are you holding these deals? Are you still getting the same percentage of dispo? If you're flipping houses, you better know your numbers, like the ones I just showed at my house down in Florida. And make wise decisions, right? Like, you do not want to put your head in the sand. You want to make wise decisions. The second point that I really want to make is that you should be considering a buy and hold strategy. And the buy and hold strategy doesn't necessarily, I'm very passive, right? Like, there are passive avenues that we're going to talk about in just a second. But you should be considering a buy and hold strategy specific to solving the problem of affordable housing, because that problem is never going away. That problem is always going to be here. And the people that service that need are going to be the ones that come out on top and find the greatest return on their investment. So let me jump into an opportunity that we have. And it's based on that ideology. We took that kind of concern, knowing it was coming, and decided that we would build something specific for our investors, for those who are a part of our network. And so I'm assuming that if you're on this call, you're a part of my network, obviously Think Realty member. And if you're not, I'm going to show you something that's a little bit inside baseball. And so if you're not a part of our network, you don't have to stay on this webinar. Feel free to jump off. But I want to show you something that we've built, and I'm just assuming if you're on here that you have been a part of my network and are part of my inner circle that has an interest in deals like this. So let me just show you the offer that we have that I believe specifically speaks to the issues that I just brought up. Okay, so I'll just go ahead and jump into the offer now. And again, it's based on what we believe is the issue of the lowest supply and unprecedented demand. And so what we decided to do is Glenn and I, based on this need, decided we would go ahead and build what we call the Mobile Vested Fund. Mobile Vested is a fund specific to buying mobile home assets on land. That's not mobile home parks. That's mobile home assets on land. And there's a very important distinction there because we believe that land is a big part of the appreciation process in gaining the value out of that, as well as providing long-term disposition and different opportunities. If you really go into mobile home parks, while we're not against that, it's just a different model. And so we're very specific to buying mobile homes on land. Most of the mobile homes we're buying are half acre to an acre and are already performing. So I'm just going to go ahead and walk you through our offer here, and then I'll open it up to questions on whether or not you have questions on the marketplace, the fund itself, or you can direct questions to me or Glenn or Justin. So let me just walk you through the offering. The offering is we're buying mobile homes on land. As you can see, these aren't your old rundown mobile homes. These mobile homes are beautiful, either new or renovated. A lot of them have granite countertops. You can see the flooring, everything is beautiful. And so you might think of something that's run down, but sitting in a mobile home park, but these are beautiful units sitting on half acre of land. And when somebody that, you've seen especially if you live in Texas or Florida or some of these states that have had massive growth, if you look at really where we are today, the same price that it would take to rent a 3-bed, 2-bath mobile home like this on a big piece of land, it'd be the same cost to go to get a 2-bedroom, 2-bath in a Class A apartment complex. And so if you've got a family, we're seeing them come to this type of product in droves. So this is the product right here that we're buying in the fund. The fund is buying performing assets. It's buying assets that already have tenants that are already paying. We're not buying assets that need rehab. We're buying assets that are already rehabbed and already have tenants. The partnership is really between the fund and Stromberg Investment Group, which is Glenn that's been doing this for 20 years in this space, as well as Stromberg Property Management. And the reason that I bring that up is because as well as I do, a fund or a syndication or turnkeys are only as good as the property management. And Glenn has over 500 of those he already currently manages in 4 states. And so adding another 40 or 50 that go into the fund, maybe 100 kind of at our largest, is not a big feat to add to his property management structure he already has. Been doing it for hundreds of investors for over 20 years. And so that's the partnership. And then obviously I'm bringing a lot of the strategy and the fund oversight and management to the table, as that's been my background, as this is my 3rd fund. The highlights are this is a proven strategy seeking funds to purchase performing and non-performing mobile homes. And these non-performing ones will be performed almost immediately, if not almost always being purchased by as performing. The first offering we have is we're going to go ahead and take in $5 million. We are open to take up to $10 million. But our goal is to really take it in $5 million tranches so that as you put your money in, there's immediate performance on that money, where we already have about $5 million worth of mobile homes that are ready to purchase today that we could go after that are already performing, that you could get a return on almost immediately. So these mobile homes will be purchased in Texas primarily, then Georgia, Florida, North Carolina, and South Carolina. We acquire mobile homes on land in A- or B- areas with great potential for cash flow and solid appreciation. And Glenn could speak to this, but these mobile homes, you'd be surprised, have appreciated as well as single family houses over the past 5 to 7 years. And you say, well, why is that? Well, the reason is because of demand. There's just not enough inventory. And so when there's not enough inventory, we're buying everything, including mobile homes on land. And so it's causing the same appreciation. Glenn, do you want to speak to that at all?
Yeah, and the one thing I do want to emphasize is in my whole career, I've never seen an affordability crisis like there is in America today. And I'll use Dallas-Fort Worth as an example. A 3-bedroom home, you can Google it, the average rent apartment, whatever is $2,500 a month, right? So that's not affordable for a lot of people. And using real numbers, properties that we bought in 2014 in that area there, it used to be like 60,000 all in. Those are selling for 200 today, right? So there's been tremendous appreciation, and like I said, there's just a higher demand because there's just less affordable housing out there, especially on the rental side.
Right. And so, we're providing this as an opportunity for you because you may not be able to go out and purchase these assets. You may not want to manage these assets. And so what we're doing is allowing you a very passive way. I will and have already put money into this fund because I'm a passive investor. I don't want to manage them like Glenn, like Glenn's company, but I definitely want a piece of these assets because I see the value in it. So the duration, and let me just make a very, very quick distinction, because the way that we have it, if you look at over to the right-hand side, it says audited return. Again, we're raising 5 million right off the bat. We'll most likely raise 10 here in short order. This is an open fund, and the duration is actually 12 months with a 6-month call. So what that means is you only have to put your money in for 12 months. Then you can request your money back at no penalty to you. And then we have 6 months to get the money back to you. It's in our best interest to get it back to you at 12 months and 1 day, if that's what you desire, because we don't want to sit on capital that can't be deployed. And so we put 18 in there because that's the worst case scenario. But in most cases, and you'll see it in the PPM, you can request it at the 12-month period. And once you have your money in for 12 months, you can request it back at any time. And then we have that window of time to return it to you. And so to go back to the point that I made, we're trying to solve affordable housing, and we're also trying to make sure that investors can stay liquid, or at least have quick access to liquidity. For you don't know what the market holds, just like we don't. But we have a surefire, strong strategy that allows us to be able to return your capital to you in a short window. And I don't know a lot of funds, I actually don't know of any funds that are right now returning capital within 12 months. But for us, these assets are in such demand, we can either sell the asset, we can raise more money. I can, put my own capital in. But again, we feel very confident that we can return this capital, and it's in there contractually. We have a 2% management fee that covers all the property management and all the fees for capital management and all of the audited returns. And we will give you quarterly updates as well as quarterly distributions. The distribution is a 8% pref or preferred return, meaning that you get the first 8% as it performs. And then beyond that, we take a 70-30 split. So our opportunity, Glenn and my opportunity, is the 70% of the performance, but then we're going to share in that upside with you. We're going to take all of Glenn's knowledge and all of my strategy, and we're going to pour that into this and make sure we're buying fantastic assets that are managed properly. And then you get to keep 30% of the upside. So you get to share in the upside with us. And our expectation is that your 8% pref should be turned into somewhere between 10 and 12%. That's returned to you quarterly. Now, in the first quarter, second quarter, it most likely will be in the 8% range because we have to allow this fund to season and perform. But our expectation is in very, very short order, you start seeing the sizable increases above that 8% preferred return. minimum investment is $50,000, and that is to get into the fund. The problem we have right now, obviously, is that we have a supply and demand issue. You can kind of see that since 2018. You can see this massive supply issue, right? And demand as it paces along, right? So you're seeing static demand and increased supply of actual people looking for these assets. The opportunity, here's just some basic stats that we put out, but workforce housing programs, rental construction reached new highs in 2020, and still remained a small if growing share of the total construction. We're seeing just massive rental housing startup or stats. And it's still not even touching the demand, and the supply is still not necessarily touching the demand. Single family rentals are larger and more likely to be located in lower density areas. And you're kind of seeing that there's a massive increase of single family rental homes that are also being built across the nation, which just kind of proves our point, is that a lot of people are trying to move away from apartments. And they're trying to find housing that has yards and something that's more suitable for their family. All of this is in the pitch deck, which we'll give you access to. I already showed you the home there. Here's the team. That's Glenn. You see him on here. That's me. I'm very involved in this, as well as an investor myself. We've got Melissa, which is the COO of Mobile Vested, as well as Stromberg Investment, and she is the operations side. You have Bobby Pearson, which we just brought on. She's our certified fund manager. She's going to be looking over all the financials and making sure that your reporting and structuring is proper. I just hired Bobby away from a banking facility, and I know Bobby in the banking world for close to 10 years. And then Justin, who's on this call with us today, who's heading up all of our acquisitions. He's been doing a lot of acquisitions in this space, has his hand on the pulse, and is making sure that we are buying and closing on performing assets here for the fund. So again, just the investment summary, you get an 8% pref. You get 30% of all the upside. So anything above that 8% and the 2% management fee. Your investment is eligible for return after 12 months, and you have a maximum of $1 million investment. So minimum of 50,000, maximum of $1 million. If you desire information on this, you can go to info@mobilevested.com, and we would ask you if you just send a quick email to info@mobilevested.com. Then we can follow up there, and we will give you access to the pitch deck and the portal and everything there. Let me just kind of turn it over to Glenn. Any thoughts on the fund or anything that maybe I've missed that you want to contribute to, and Justin as well?
Yeah, no, I would just say, once again, I think, we're timing this at the right time. When the properties that are going into the fund are substantially discounted compared to new manufactured homes too. They're substantially, if you put a new manufactured home on the land, it wouldn't bring any more rent. These are existing ones that have been rehabbed, and they're, like I say, that's why there's a whole lot more upside on these two. And the returns are much better than a single family house in almost all cases.
Very good. Justin, how about you on the acquisitions or anything you're currently seeing?
Yeah, on the acquisitions, kind of like Glenn alluded to a little earlier, what you used to could buy these properties for, of course, $60,000. I mean, they've doubled at just like a brick and mortar house. And I think that's what a lot of people get, confused. They think, kind of like Eddie alluded to at the first of when we started, mobile home parks are nothing like, brick and mortars on lanes. What we do as a company, Stromberg, and what this fund offers is completely just turns that on its head, because the way we do land and with the mobile home, it is exactly like a brick and mortar, as far as title wise, everything. And as you can see, as far as appreciation, in some cases is even better. I mean, because even after it appreciates, let's say from 60,000 to 200,000, it's still affordable, because you're not going to get a brick and mortar house for that price. I know like Eddie said, you watch the news, you hear people talk, doomsday scenario. This opportunity that we're offering, the reason we're so excited about it and the reason we're offering it is because we see at Stromberg, we see the day-to-day far as our tenant applications coming in to rent our properties. We see the demand that our properties are getting. And when I say tenants coming in over the last couple of months, we can already see the shift of the families that, like I said, might have been looking to buy, a house. Cause I mean, a $300,000 house at 3% interest rate versus a $300,000 house at a 6% interest rate. I mean, that's about a $600 swing in monthly payment for a family.
Yeah.
I know millennials because I am a millennial. And like I said, with Gen X, I mean, that sways a lot of people because like I said, the dollar amount's not the big thing. It's the monthly payment, being able to afford it. So those people that can't afford that, if they've got kids, because our tenant's not the single, man or woman, it's a family, got kids. They don't want to put their family in an apartment complex. They want to be able to let the kids run outside, play. That's our tenant. We're getting people that got good jobs, great credit. I mean, we've seen this, unfortunately, the down cycle that the market's having right now. It's a huge opportunity for us because our tenants are better. The prices are starting to come down, which means we're able to buy in areas that, let's say, kind of like Glenn said, 4 to 6 months ago, we couldn't make the math make sense. Now we're having realtors call us back from properties 4 or 5 months ago, and they're offering $40,000 to $50,000 less. So then we can make those properties work. So the opportunity we're offering, affordable housing, kind of like Eddie said, it's not going anywhere. Yeah. But we are offering it, and the opportunity to get your liquidity back after a year, I don't think you can find a better opportunity. I just don't.
Yeah. It's well said. I mean, I want to kind of push you if you're thinking about it. I probably know a lot of you on the call. If you've got a bunch of cash sitting in a bank account, I know that makes you feel good. But I was talking to one of the founders of Quest, and he said he had a phone call with a guy that asked him. He said, "I've got $500,000 sitting in my IRA account right now," and he said, "When should I buy? Should I wait? Should I hold?" And he said, "Well, let me tell you something." He said, "If you got cash sitting there," he said, "your 500,000 is going to be worth 400,000 next year." He said, "And everything that you thought you could buy today at 500,000, you're going to have to spend 600,000." He said, "The opportunity cost that you are costing yourself," he said, "is going to be so detrimental." And so we want to offer you a great opportunity to get involved, have quick liquidity back. You can manage your cash to the point if you need it back in a year, you let us know. We can get your money back to you. Or if you find a better deal or better opportunity. I know liquidity is a problem that we have to solve. And so we decided we would go after solving this way. We built this fund specifically for this time period because we believe that this was the best way to help you, the investor, as well as solving problems in the marketplace, which is putting more affordable housing stock in front of renters so that they can find and get into what they need and what they want. So we believe it's a pretty solid offer. We have quite a few people that are already signing up for it. We launched it this past weekend at the Quest event in Houston. We had huge success there. And so don't wait, get involved. Once we hit the 5 million, we'll close it down for a little while until we have the enough assets to buy again. And we'll open it back up after that. So again, $50,000 all the way up to $1 million. If you have any questions, I'll go ahead and open it up for that right now. Anybody have any questions? I'll just let you, put them in there right now. If you have any questions in the chat or in the Q&A section, either way is fine. And if not, I want you to go to info@mobilevested.com. We'll at least get you all the information. You can read through the pitch deck. You can look through the PPM. You can look through the offer. You can ask us any questions there. We'll give all that information to you so you can make a qualified decision. You don't have to make a decision right this minute, but at least put yourself in a position to look at all the data and the information to make a good decision about this opportunity. Again, I'm an investor. I'm putting a lot of cash in because, for me, it serves the exact same need that you most likely have as well. Glenn or Justin, any other thoughts? I don't see any questions. So
no, I just think, once again, I look at this as we're meeting the needs of the market, right? We're the liquidity side, the safety side. I think there's big upside potential in it. And so, yeah, I'm putting a lot of my money in it too. So that's,
Yeah.
I'm putting.
Yeah,
both.
if you've got self-directed IRA money sitting dormant right now, and that's what we heard all weekend long was, there's
Yes.
no reason I should just be letting my retirement account sit there. If you got self-directed IRA money, this is a no-brainer. I get putting a lot of cash into your savings account and, being cautious during this time period. I get it. But if you've got self-directed IRA money sitting there undeployed, that's not really smart right now. So anyways, thank you so much for joining us tonight. I hope that you were encouraged. I hope you decide to take more of the investor mindset, not the consumer mindset. Keep getting involved in webinars and stuff like this versus listening to CNN and CNBC and Fox News, because Lord knows that is not the greatest place to get investment advice. But keep staying engaged with Think Realty. Thank you so much for being a part. If you have any questions, again, go to info@mobilevested.com, and we will talk to you soon. And happy to answer any questions you might have. Have a great night, and hope to talk to you soon.
Thank y'all.
Thank you. Appreciate it.